Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about an actual client case that we did for a client just a few weeks ago. And basically they hired us to do a fee-for-service plan. So they gave us all their data. We put it into our software. We ran some strategy that we do, looked at taxes, income, all of that. How does every piece of the pie come together? I think a lot of people when they hit retirement, and I talk to a lot of you day in and day out, and we look at things in silos too much. It's like, okay, this account I need to do this with, and this I need to do this. And we kind of are wired to do these typical things. And I think a lot of it we get from neighbors or friends or coworkers or whatever, but it's not always the right decision. So the client that we're going through today essentially said, Adam, here's our stuff. How do we maximize income, minimize taxes, and just create the best retirement? We worked hard to build this up, and as you'll see, they have a fair amount of assets. Now, we did that plan for them. And a few days later, they came back and said, Adam, there's something that doesn't add up. We didn't tell you, but we actually had our bank do a plan prior to you doing a plan as well. And we've compared the two, and there's $1 million difference in the amount of tax we're going to pay until age 86. The tax they're going to pay at the bank plan essentially is $2.8 million. In the plan that we did, it was $1.8 million. So where's the difference? We didn't add any more assets in. We didn't really do it. It's just strategy. Where you pull money from, how you pull money from, timing of it, all of that. So we're going to break all that down in this video. So I'm in our planning software now, and as you can see, Easton and Everly Bornn are the clients. Obviously, we changed our client's name for many purposes. As you can see here, this is the bank plan that was put together. Now, I will highlight, and I'll go back to this later, income. So the bank plan generated a very nice income. $141,146 after tax in their pocket, and this is adjusted all the way till age 95 for them. Okay, so $141,000, very nice income. They have capital assets, so they have about $3.6 million in assets, which I'll break down here in a minute. They have a fairly large non-registered account. This client worked for a large multinational, and a lot of their assets are sitting in company shares of that company. Okay, and that's where this plan really gets wound down at the bank in an improper way and creates a lot of tax bills. So that's what we really want to show you. As you can see, this first year on the bank plan, the client is paying $471,000 in tax in 2022. The following years, 1,000, 2,000, 4, 4, 3, 3, 2, 1. Okay, there's years where there's zero, and then it picks up to 67, 71, 72. So it's this big swinging tax bill, right? Lots the first year, then really none for about 10 years. And then, close to 100 grand a year in tax bill. So this is what the bank had put together for them. Now, how do we get to that tax bill? So let's break down that. So I'll jump into the software here again, and we'll go through kind of what's happening in this plan, what's assumed as far as CPP and drawing down and all that. So just breaking down the assets here, you can see Easton had 0 TFSA account here. So no TFSA for Easton. The RSP, $1.28 million. So nice RSP that he built up. Stock account. So this stock account, that is one stock held. Okay, so that's one stock or many stocks, but one company stock. And that's the issue. Okay, so you can see the cost or the value is 2.2 million. The cost based on there is $330,000. So obviously a very large tax position there if they were to liquidate that. They do have about $150,000 in savings. And then I created this bank investment, and there's $0 in there, and I'll show you here in a second why that account's there. Now, if I go over to Everly, no TFSA used, about $500,000 in RSP, $72,000 in a locked-in account, and again, that joint savings shows there as well. Okay, so most of the assets are sitting on his side, big RSP and that stock account. So that's what's creating the really big tax bill. So what we need to look at is how do we unwind this big position in one company? $330,000 cost base, $2.2 million value, right? Great growth, but we need to pay the tax in between there now. So how do we do that? So on the bank plan, I'll just jump back in here. We're looking, we'll go to Easton. Okay, so we'll look at his unwinding. When we look at capital assets here in the middle, and I'll zoom in a little bit here for you. So you can see here, what they've done is they've unwound that stock account. Okay, there's 2.2 million negative. That means that's being sold. So what the bank said is, look, you have this big stock account, whether we don't like it or we're not managing it, so maybe we want to manage it, or hey, pay your tax now, you have after-tax dollars then, and you can pull that out going forward. So essentially what the bank did was they pulled out the $2.2 million, and they moved whatever the client doesn't need for income that year and after taxes over to a bank investment account, mutual fund, or whatever they were going to shove the client into. Okay. Now you can see here, going back, that tax bill's $471,000. That's a large tax bill to pay. Now they've topped up the TFSA, and they continue to top up the TFSA. 81,500, 6,000, 65, 65. So that keeps growing until they actually need to start drawing that down. Now again, if we look over to this bank investment, I think this is what's important. The strategy that they took is, look, let's sell these shares of a great company. Let's pay the tax. Let's put the remaining assets in an investment at the bank and let us manage it for you. And then we'll wind it down over the next, about 9 years. Okay. And then when that's gone, then we'll take out your RSPs and your TFSAs and start winding down your other accounts. But in the meantime, we recommend that you take your CPP at age 60. Okay. So for both Easton and Everly, they recommend to take your CPP at age 60 and your old age security at 65. So basically the income coming in is, as you can see here, it's $200,000 are coming in out of their investment account every single year for 2, 4, 6, 8, 9 years. Okay. Until it's gone. So that individual stock that the client held is now liquidated. A bunch of taxes have been paid, and it's liquidated over about 8, 9 years. They've also started CPP. So if we look at the CPP, you can see the CPP coming out here. Okay, and it started at age 60. Okay, OAS starting at 65. Okay, so the whole bank plan, the whole premise behind the bank plan was, okay, let's start your CPP at 60. We'll start your OAS at 65. So we'll get that government income coming in. We're going to take your shares of this great company. We're going to liquidate it. Okay, we're going to pay the tax now up front so that we can have after-tax dollars to draw out of. They draw down that account over 8 years, and as soon as that account is wiped out, then that's when they start drawing on the RSP and the TFSA. So if we jump back in here, the investment account is drawn out. Okay, on the right-hand side here, bank account drawn out. And then what do we start doing? TFSA drawn out. And then we're waiting all the way till almost 70 for that RSP. Okay, and the RSP is growing to 2.7 million, and they're drawing that out. So that's the strategy. Now, how do the numbers come together? That's what we want to look at. Okay, sure, this is a strategy, right? There's lots of different strategies people can employ. This is one of them. Now, this was given to them by their bank, by their financial planner of over 20 years. They were hoping they could trust this plan. When we put our plan together, they obviously realized that couldn't be trusted. Now, what are the numbers behind this? So let's break down those numbers. Okay, so looking at the numbers here on the bank plan, again, we've made the same assumption, same account values, everything like that for each account. Okay, so Easton's getting a 6.5% rate of return. Everly's a 5% rate of return. That's what the bank had assumed on their plan, so that's what we compared against. Why they did that, I'm not sure, but that's what they had done. So we wanted to compare apples to apples. Again, it generated a very nice income, $141,146 after tax income. Okay, that is a very nice income to have. No complaints there. Now, the estate, okay? So the estate at age 86, if they were to die, is worth $4.46 million after tax, okay? Estate at 95, $4.1 million. So very nice estates, obviously. Nominal till 86, what is this number? This is the actual dollar amount they're going to receive in their pocket from now, retirement, to age 86. So all the actual dollar after tax money that they're going to collect, $6.1 million. So lots of money coming in, obviously. Now, this is what I want to focus on. The tax bill, okay? This tax bill is $2.86 million. That's the amount of tax they're going to pay from now until age 86, plus if they died at 86, any estate tax, okay? So if this client lives from now, which is, the late 50s, to age 86, and they pass away at life expectancy, they both pass away, between the tax bill they're going to pay in retirement and at death, estate tax, the total is $2.86 million, okay? Massive tax bill. If they live all the way till 95, their total taxes paid are $2.46. Now, it's lower to 95 because that estate tax is getting wound down and the tax bill is getting averaged out over a few years versus 1 year. Okay, so that's why that's lower. That's typically what we see. 2.86 million, 6.1 million. Now, let's fast forward to the plan that we put together for them. Okay, and we'll show a direct comparison here and then you can compare. Okay, so let's look at the parallel wealth plan that we put. And again, we put this plan together not knowing that that the bank had put together a plan at all. We had no idea. They came back to us afterwards and we compared. Okay, our plan, which I'll go through here in a second, $158,000. Okay, so we gave them, you know, between $158 and $141. That's $17,000, $17,500 more of income after tax every year for, you know, from now to 95. Okay, and for them that's about 40 years. So that's a massive amount of money. And as you can see, we go from that $6.1 million up here down to $6.8 million. So an extra $700,000 in their pocket, that's a lot of money. No one's going to complain about having an extra $700,000 from now to age 86. Again, not till 95, just till age 86. An extra $700,000 in their pocket. And again, that's about $17,000 a year. The difference between the 158 and the 141. Okay. Now, if we look at their estate, at age 86, their estate would be worth $4.91 million versus $4.46. So we have a larger estate at age 86, which is life expectancy, and roughly the same at 95, 4.1, 4.1. Now, the big difference, the tax is $1.89 million in tax versus the 2.8. Okay, that's $1 million saved in taxes. Now remember, their after-tax income in their pocket has jumped $700,000, okay? So they're not just saving taxes, they're putting after-tax money, much more, in their pocket, and their estate is worth about $450,000, $500,000 more if they were to die at age 86, okay? That's checking a whole lot of boxes. Again, if they were to live all the way till age 95, they're still looking at 2.46 on the bank plan, 1.92 in tax here, okay? Plus all the extra added income, okay? Much more income, much less tax, okay? This is an extreme example, but these are examples that we come across with our clients day in and day out. Now, this is obviously on the high end. If we can save $1 million in tax and give an extra $700,000 of income after tax, that's a lot of value, okay? $1.7 million, and there's some other, you know, features within the plan that really, you know, give them flexibility and structure in that as well. Now, how do we do that? How do we create $1 million less of tax and $700,000 more of income? Now, you're going to be sitting there saying, look, Adam, this is great, but I don't have, you know, $3-4 million of assets. That's fine. We do these plans for clients with $10 in their investment account, with $100,000, with $500,000, with $1 million. It doesn't matter. The strategy works the same, and I can tell you this, the strategy works the same across the board, regardless of assets. The more assets you have, the larger the savings can be, absolutely. But the strategy and the savings happen regardless of amount of assets that you have. So as we jump into the parallel wealth plan, as you can see, this is the parallel wealth plan now. You can see that income has jumped up. Okay, 158,670. That's the amount of income, the after-tax income they're going to have in their pocket. Now, people always ask, like, what's this nominal dollar, Adam? This is what the actual dollar amount is that they'll have in their pocket, not the number beside. Okay, so let's grab age 65, 66. They're going to have $193,418 in their pocket, which is equivalent to $158,670 today. Okay, that's how we build that out. So we want this income to stay the same, attached to inflation. Okay, and in this scenario, we put inflation at 2%. So whether it's 2, 3, 4, it doesn't matter. We want that buying power to stay the same. Now again, we put 2% inflation in both plans here. Rate of return for Easton at 6.5%, for Everly at 5%. We're comparing apples to apples. Now, so where does the difference happen? First off, I highlighted it before, so I want to highlight it here, is the total tax bill. Okay, you can see here, it's level, 80, 70, 60, 50, 50, 40, 50, 50. It's in a range, right? And that's what we're looking to do. We're trying to create a range for that tax bill, okay? Now, how do we do that? We want to make sure that we're leveling out and taking from different accounts at different times, but structuring it properly. So the first key point within the plan that we put together for them was we delayed CPP and old age security until age 70. You can see here we're looking at Easton right now, age 70. That's when both CPP and OAS. Okay, there's your CPP, there's your OAS. That's when we turn it on. Now, Obviously, he has a large amount of assets, or they have a large amount of assets. So you have this OAS clawback. Okay, there's a clawback here, so this is what they're getting clawed back. This is what they're actually receiving. Okay, so they are getting some of their old age security, maybe about a third of their old age security over time they're going to get. It does increase over time. As you can see, they're going to collect 9,900 and they're losing 65. So it gets better over time. But again, with high income, high asset clients, often there will be that OAS clawback. But by delaying it to 70, we've been able to kind of wind down. We look at that OAS clawback as a silo. Once we create this, we look at that OAS clawback and compare the differences between plans to make sure that it kind of incorporates into the plan. We don't like to see that clawback, obviously, but it's going to happen for some clients. So if it's going to happen, how do we reduce it? And how do we kind of massage it within the rest of your plan and tax strategy? So that's all we're doing here. So again, we're looking at the CPP and OAS both starting at 70. Okay, so where's income coming from between now and 70? Let's break that down. So here's Easton's capital assets. Again, we have a TFSA, we have an RSP, we have stocks, and we have savings. Now, what we looked at doing, and again, this was before the bank plan came on our lap, but we looked at, okay, let's take your stock portfolio. We like the stock, but we want to start drawing this down over time. We don't want that to sit there for too long. So we're pulling about $200,000 to $250,000 out every year. It jumps up here one year, but essentially, $200,000 to $250,000 early, and then about 150 or a bit less going forward. Okay, so we're slowly drawing down this stock account. He had some savings as well, that joint savings. We're drawing that down as well. It was some savings that they had they don't need anymore. It made sense to draw it down. Again, you can see the rate of return on there is 1%, which is what they're getting. So you thought, that money's not really working for you. Let's slowly kind of draw that down. Let's draw your stock portfolio down. Let's continue to top up every year a bit into your TFSA. The idea though is, Adam, why not top up their TFSA all the way? He's got full contribution room. It's because we're triggering a tax bill. If we want to top up that TFSA, we need to pull money either out of their RSP or out of their stock account. Both trigger a tax bill. And that tax bill just didn't make sense. It made sense to do about that 15,000 mark and no more. So that's what we're looking to do. So, more level out the drawdown from their stock account. As you can see here, as the stock account goes, it lasts for a while, but we emptied it out, if I look at the age here, by 84. So by 84 years old, that stock account is gone. Now their RRSP. So for Easton, we started to take that RRSP, you can see that $55,000 here. We started that at age 64. Okay, so again, we looked at, they had some other expenditures. If we look over on their income, you can see they have some rent and expenses and stuff. So we had to take that into consideration as well. But again, winding down that stock account, taking out their RSP, and just really winding that down. Now, again, RSP, it was a large RSP, but we were still able to wind it down by about 87. By the time he's 88, there's nothing left in there. Okay. Now, again, why not take that RSP earlier, right? There's many years there where we're not touching RSP. And really that comes into kind of the cohesive plan that we want to look at with Everly, right? Everly has income too. So what we've done here on Everly's side, again, we're topping up that TFSA a bit, but we're drawing out her RSP more aggressively early on. So 55, 60, 65,000. Then as soon as we, flick the switch on his RSP, which is right here, we drop her from 65 to 18. Okay, so we're taking more out of hers, and then we're dropping it down. Now, why do we do that? Why do we say, look, Easton, take more out of your stock portfolio, delay that RSP meltdown until 64 versus taking it now? Typically we say, yeah, take it down, draw it down. Well, the reason is income splitting, okay? Before age 65, you can't income split, right? Unless it's a pension. They don't have a pension. They have RSPs and they have this big stock portfolio. So by taking income from her out of her RSP and him out of the stock portfolio, it's leveling out that tax bill between them, okay? So that's what we want to do. We want to level that out. Now, once he hits 64, then 65 is really when we start to ramp up his RSP and cut hers down. At 65 onwards, you can split RIF income, okay? So now he's taking a massive amount of money out of his RSP or out of his RIF, and he's able to split that with his wife, okay? So if we go back in here, you can see here, 64, there's 55,000 coming out, not much. At 65, that's when 140,000 comes out of the account. And if we scroll over, there's a little column here that says pension income splitting. and it has a $70,000 number there. That means that Easton is able to share $70,000 of income on paper with his wife. What does this do? It levels out their tax bill, okay? So that's the tax strategy behind it. Now, I will take a quick screenshot here and show you the effect of tax rates, okay? So if we look at tax rates here, the effective tax rate, that's your average tax rate, and I know this is quite small, but you can see it stays right around that 25%, okay? We're keeping his tax rate very level, whether it's coming out of his stock portfolio here or his RSP here. We're leveling out that tax bill, okay? That's very important to do. That's where the bank plan failed. It had high tax rates, it had no tax rates. It was bouncing all around. If you can level out that tax bill in retirement, you're gonna be in a much better position than you would otherwise. Again, with Everly, it's the same situation here. So if we take a screenshot here again, you can see that average tax rate. She floats in that 18 to 20%, 17 to 20% right through retirement. That's what we're looking to do. We're looking to average out that tax bill. We see it again and again when we build out plans. It gives you a lower tax bill through retirement and at your estate, if you pass away in the 85 to 95 age range. So here I just want to quickly jump back to that bank plan. As I was talking about tax rates and bouncing tax rates, I just wanted to show you the effect of that, okay? So here's Easton's effective tax rate, average tax rate. Again, you can see that first year when they trigger the sale of all the shares, he's paying an average tax rate of 50%. Now, I don't think anyone wants to pay an average tax rate of 50%, especially when your tax bill is $439,000 that year. And then the problem is, again, very, very to no tax rate, like 4, 4, 7, 8, down to 0. And then you can see this is year 1 of RSP redemptions. It jumps back up to 23, okay? So they're front end loading that tax bill. And as you can see by the numbers, they don't lie. It's hard to make up these this drastic of a savings, but you can see here, we're going from 141,000 of income, after-tax income, down to 158,000, okay? Everything else is the same. We haven't changed the parameters of the plan. All we've done is we've taken strategy and put it within the plan. Again, we've gone from 6.1 million in after-tax income in their pocket from now to age 86 to 6.8. $700,000 plus of more income in their pocket. That's to spend, that's to travel, that's to help their 2 kids out. That's money that they can use. Anyone can use. That doesn't matter what your situation is. Okay? And again, the tax bill. 2.8 to 1.8. We've saved them $1 million in taxes. And that's where they came back to us and they said, Adam, your plan doesn't make sense. There's no way that over the next 30 years, under 30 years, you can save us $1 million in taxes. It's just not possible. Well, there's where it is, okay? Again, the bank plan, let's just summarize. The bank plan had them taking CPP at 60, old age security at 65. They had that stock portfolio worth $2.2 million. They're liquidating that in 2022, right away. Let's sell that. Let's pay the tax. Let's top up TFSA, and we'll put the rest into a bank investment, whatever that is, mutual fund, whatever it is. Doesn't really matter. It's earning 6.5%. Once it runs dry, then we're going to pull out of the TFSA. When that runs dry, we're going to pull out of your RSP. Again, the RSP, they're not starting till close to 70, and they're drawing that out. And the problem is, again, that estate tax later on. When this client is in their late 80s, early 90s, they have millions of dollars left in their RSP. But that's the plan that the bank put together. Flip over to our side. What did we do? We recommended delaying both CPP and old age security for them to age 70. Don't liquidate the stock portfolio all in 1 year. Liquidate it over time, okay? Level out that tax bill. Put a bit of money into the TFSA, start building that up, right? Gives you that flexibility when you need some tax-free money. You don't want to drive up your income. And then at age 65, we started aggressively pulling out his RSP. We grabbed her RSP aggressively before that. That's to level out the tax bill. He was pulling non-registered for his tax bill. She was pulling RSP for her tax bill. Once he hit 65 and can income split his RIF income, then we started pulling out about $155,000 per year out of his RSP or out of his RIF, because he was able to split $70,000 of that income over to his wife to level out that family tax bill and their personal tax bill. That's the strategy. Delay RSP, melt down that RSP as quick as possible and look at tax strategy within that. And again, we're drawing down that stock portfolio over a period of time. Now, he was comfortable with that. Again, he owns stock of a company that, a very solid company, pays dividends, comfortable in owning that stock. If this was a client that said, look, this is, you know, a high risk stock, there's 2.2 million, I don't really like the outlook of the company, I want to liquidate it, then we'd probably want to liquidate it over 5 or 6 years, maybe more aggressively up front. But again, the strategy around the TFSA or around the CPP and OAS and drawing down that RSP would stay intact. So we kind of have to massage everything together. Again, when you look at your retirement income, you have to look at it as a cohesive plan. Okay, too many of you, and I talk to you guys every day, it's silos. You look at it in all these different silos. You need to put a plan together. Everything kind of molds together. Just because your bridge benefit on your pension drops at 65 doesn't mean your CPP starts at 65. Okay, why don't you delay your CPP? Melt down that RSP a bit more. Give yourself the benefit of that tax savings. Okay, most of you aren't doing that. There's strategy behind the assets that you've built up. I think everyone watching this video can agree. We want to pay as little tax as possible, and we want as much income as possible. I think all of you are sitting in that bucket. No one's sitting there saying, no, I don't need more income and I want to pay more tax. I just don't think that happens, okay? You need to have a strategy behind the assets that you've built up. You've worked hard to get to this point. You want to retire once and you want to do it well. Make sure you have a clear, comprehensive plan. If you don't have a plan, if you saw what I went through today, again, our software is quite comprehensive. I'll jump back to it just so you can kind of see it. You know, we can break down pretty much anything within these plans. Again, we look at husband and wife individually. You know, we can put in your different incomes, your assets, you know, everything. We can kind of map out everything within here. If you have rental properties, we can put them in here. If you have a corporation, we have a corporation. You know, donations, insurance policies. Everyone has a different strategy. Again, this client, you can see in the middle of the page here, they have some added expenses that they want to help the kids out with. They're renting a downtown property right now for a few more years that they want to have access to, so when they head into town. So they have these added expenses. We can build that into the plan. Okay, that's doable, as you can see here. So if you don't have a clear plan, a clear strategy, where your money's coming from, how much it's going to be, how long it's going to last, how to reduce your tax bill, when to take your government benefits, all of that, get a plan in place. Talk to your financial planner. If you don't have one, reach out to our office. You can go to Parallel Wealth, www.parallelwealth.com/planning. Okay, we break down our fee-for-service financial planning there, what we offer, the cost of it, the structure, kind of the process to it. We provide these plans back to a lot of you viewers every single day, and we see the benefit. Again, this is a massive, $1 million tax savings, $700,000 of added income. This is obviously a big difference, but typically it's $50,000 to $250,000, $300,000 of tax savings. It's there for all of you. It's just how do you unwind it? How do you properly structure your plan? If you don't have a plan, reach out to our office. We're happy to help you out. So thanks so much for joining us in this video. Hopefully, I know we bounced around between the screen and me and all that. Hopefully you didn't get dizzy. Go back, watch it in slow motion if you need to. That's the great thing about YouTube, is you can slow it down, watch it slower, look at the numbers, pause it, all that. Get a good grasp on what this client was doing, because this strategy is what we use for a lot of our clients. Again, your numbers are different than the next person's. This strategy, again, we don't touch Easton's RSP until he's 65. Not typically what we do, but again, the pieces have to come together in a cohesive income and tax strategy. So again, thank you for joining us in this video. If you're not subscribed to the channel, hit the subscribe button below. It takes 1 second, it costs you nothing. And if you enjoy these videos, if they help you out, if they give you strategy, if they've maybe made you money just through different strategies that you've implemented, hit the thumbs up. It really does help get these videos out to more people. So thank you for watching. We really do appreciate the views, and we'll see you in the next video.